Okay, so welcome to part three. This is where I just sort of take a little look at the macro picture. Uh, it does get cloudy at times. Hopefully by the end of this week, we're going to see a little bit of a clearer path. So stocks had yet another up week. Can this really continue? Okay, we've got a bull trend and we're back in that bull trend after sort of over a decade of it, and then it sort of turned bearish and now we're back in it again. Can this continue and for how long? Especially when potential for recessions, and of course it's a matter of whether they actually do arrive or not. So we should find out this week whether what the Fed's going to do. Their decision should be 25 basis points. And I expect that they're going to hold another one in reserve just in case the data merits it sometime in the future. I'm not sure it's going to be back to back after this one, but again, that's going to be data dependent. And of course, we've also got plenty more data coming out from the US this week because we've got the Fed's preferred inflation metric of PCE. So overall, it's going to be an exciting week. Now, for me, although inflation is lower, it's still not at that 2% target that the central banks have set. And, part of that is still because that's that lack of workers, which keeps those wages higher. We've had lots of hikes in rates, haven't we? I mean, just so many over just over a year. But I think that the fact that all these have happened, it's still not being fully felt in the economy yet. And that is an impact. It's quite lagging. It could be months and months before they're really felt. So some of the earlier ones, yeah, they're coming through now. But we could still have another few months before all of these rate hikes have really impacted the economy. On the economy, I still believe that the US has the best economy. And, there is a massive potential at the moment that they could end up with a soft landing, which I think really would be in contrast to some of the others, which includes Europe and the UK. Now, a concern for me is these food supply chains could be challenged again. We've got El Nino, which is this weather front. It can either turn weather topsy-turvy or it can sort of exaggerate the weather. And as you're seeing, there's been a major impact on temperatures, especially in the US and Europe, where it's been hot, hot, hot. The UK, not so much. I'm based in the UK, and actually, our temperature's pretty tame at the moment. In fact, it's a little bit on the underrated side. So we've got a very mixed summer so far. Now, all of this sort of based on sort of El Nino could reduce agricultural supplies in the States and in Europe. And of course, that could be really exacerbated by Russia withdrawing from the Black Sea Accord. Because in the following days after that, they've been bombing Ukraine's ports and also their storage facilities. So that, they're still attacking all the infrastructure. And this weekend, Odessa was attacked over the weekend as well. So just keep an eye on wheat and corn prices. They're sort of got the potential to spike. They did have a reaction and go up, but they haven't sort of had that major reaction that they had the first time round. But I just sort of say that because if you start seeing those prices go up, well, it's a trading opportunity, but also it's going to tell you that inflation might turn around just a little bit. Especially as oil seems sort of very comfortable in the mid-70s at the moment for WTI. Now, we've seen the dollar drop in and drop in. There was a lot of bears in the market. It fell below 100. That's the Dixie, the dollar index. And saying that, some of the data last week did come back and give it a little bit of a boost, and it has moved back over 101. And of course, that's sort of been at the cost of the euro and the pound giving up some of their recent gains. But, I've been mentioning that I thought that the dollar was cheap, and, fortunately I bought some cable pound against the dollar put options. And even where they are at the moment, I still don't think they're justified. But that's not a recommendation. I'm just giving you my personal view there. Now, gold is providing plenty of opportunities on a daily basis. It's having some really good swings. Generally sort of about $10 a day. Again, it's just a matter of getting it right. If you can't see how to do that, then join one of our technical analysis courses and I can help you there. I can show you what I use. Okay, so, as I've just been mentioning about the grains and all that, so, and oil steady, we could just see one last spike in inflation, which is not going to make the central banks very happy. But, if grain prices do have that prolonged rally, so far it hasn't really happened, but that doesn't mean that it won't. And I suppose the next 2 or 3 weeks would probably determine if it's going to. It depends how aggressive Russia is with these attacks that they're doing on sort of those particular areas. Another area of concern for me is banks and institutions. They're holding on to a whole mass of bonds from sort of the COVID era. Doesn't that seem so long away now? Just like, what is it, 2-3 years, but it just seems as though so is history set now. Now, for me, when we talk about holding all these bonds, we should generally round about this 2% yield, because that's where they were really before central banks started to put those rates up. And of course, we've got to include central banks themselves when we're talking about all of this, because they are losing seriously large sums of money, from the tens to the hundreds of billions, I would say, on their just look at their balance sheet and the makeup of that balance sheet. You can see the amount of bonds that they're holding, and of course they bought absolute huge amounts of those over COVID. So yeah, and funnily enough, they're the ones that are moving the market against themselves, because they're the ones that's pushing the rates up. So that's a bit of a oops there, really. Nothing like pushing the market against yourself. And of course, this is followed by corporate debt. So, and again, is that going to trigger the next crisis? In the US, it's probably around about $500 billion. With rates where they are, and if they do go up and they stay up here, which they're going to for some time, that could lead to bankruptcies. And of course, not only that, but it would strain the credit markets as well. Now, on top of that, we've got this potential for stricter regulations for the banking sector as well. They're going to have to increase their capital that they hold. And so if that happens, then sort of, let's face it, that part of that is because of the earlier banking disasters this year. So it's not just a matter of corporates and banks under pressure from higher rates, but it's just everybody. I mean, if you look at it, I mean, there's millions that are coming, they're sort of reaching the end of their cheap fixed rate part of their mortgage. Sort of they give you this cheaper rate to get you into these homes, but a lot of them are just coming to the end now for millions of people. Now, for me, that's going to see sort of many probably paying close to double what their repayments have been. And of course, that's going to test many whether they can actually afford that or not. And that could lead to them having to sell, not wanting to sell, but having to sell. Because, they're unable to afford where they live at the moment. Now, that could drive house prices lower again. However, for me personally, as I've said before, I think the best solution would be to allow these guys that have got these mortgages to extend their mortgage by, I don't know, maybe 5 or 10 years, whatever it needs to be, to minimise that increase at the moment. And the UK remains resilient despite the highest inflation among its peers. The inflation data last week, okay, it was better than expected, but it's still well too high. And it could have been enough just to convince the Bank of England to only hike by 25 basis points at their next meeting. It's sort of 25 basis points seems to be the norm at the moment, doesn't it? So it's likely to be the same outcome for the Fed and the ECB this week. And then we come to the exception, which is Japan. Japan's just Japan, and it remains reluctant to move back into positive rates, although I do see that happening by the end of this year. However, they could sort of do a little bit of a tweak to their yield curve control that they've implemented. Something I did forget to mention in the UK was tourism is now pretty much back to pre-COVID levels, which again is good for the UK economy. So that's about it for this. All that leaves me to say on this part is, it's going to be an interesting week. Hopefully by the end of this, it's going to give us a little bit more of a clearer picture of where we're heading over the next couple of months. So stay with us for part 4, which is where I do some analysis on a variety of different asset classes. So again, I'm just going to leave it for you to read. I'm sure you know it by now if you've been following us for a while. But we offer you lots and lots of help in all different ways. So just reach out to us. We'll help you in any way we can. It's what I like to do. I love to share my 50 years in the markets.